Hello. Today's video lecture covers Chapter 9 from your text, Storage and Inventory Controls, and it starts on page 122 of your textbook. Here's your objectives, which are on page 123, and you're going to learn about today developing the standards with regards to proper storage controls, perform and cost a physical inventory, calculate the food cost of sales, maintain a perpetual inventory, and implement efficient and cost-effective issuing controls. See, once the products have been received and the products that did not go directly into production are moved into storage for later use. Now, the purpose of maintaining proper storage controls is to control spoilage, and then, of course, theft of goods. Now, let's look how we can establish effective storage controls and why we do so. Be sure to read the pages and be prepared to discuss in class pages 124 to 128 in your textbook. Storage controls. Size of the storage area is really important. The National Restaurant Association states as a rule of thumb, restaurants should typically have 5 square footage of storage space per seat in their operation. And ideally, the location should be between the receiving and production areas to ease the flow of goods through the food service operation. Now, theft and pilferage must always be considered. Theft usually refers to the unauthorized removal of goods by a non-employee, whereas pilferage is from an employee. This can be a serious threat to cost control within the food service operations, and it can happen even under tight controls. So many times you can employ a clerk to prevent theft. If there's someone in the storeroom during operating hours, they will be able to control and note anything that leaves the storeroom. Also, camera technology is becoming more advanced and much more commonplace. Storage conditions, in order to utilize products, times, and temperatures, must be maintained and consumed by the end of their shelf life. Now, what did we say shelf life was? It's a recommended amount of time a product will maintain its quality for use in production. And this is on page 124 in your book. Storage equipment refers to the proper shelves and containers, and moving equipment makes the storage process easier and more efficient. What's the benefit of slotted shelves and solid shelves? What's the difference? Well, these are all things you need to take into consideration when you're cooling down things in the refrigeration area, holding things in the dry storage area. So cleanliness, this is discussed in real detail on page 126, is really important because in addition to tidy and clean storage facilities, it's extremely important the area is clean so it will not attract rodents and insects. So setting up that storage area in designated locations for each item discussed on page 127. Like mise en place, just like you do in class, everything has a place and everything in its place. FIFO is first in, first out. This is a method of stock rotation that should be used to ensure products are used before the shelf life expires. This makes dollars and cents. Storage areas must be employee friendly to ensure stock is rotated correctly. Otherwise, someone might get hurt. So you would need to make sure that they're using proper guidelines for receiving. Okay, now we're going to transition from storage into inventory. Establishing inventory controls on page 129. Most food service organizations usually use 2 types of storage controls. Let's talk about the first one, physical inventory. This is an actual count. You get to feel it, you get to handle it. This is physically labor where you go in and count all the food and beverage products on hand. This is usually taken once a month. It's taken between the end of the business at the end of the month and before the business activity on the first of the month. The second is often referred to as the periodic inventory because it's taken at regular periodic. This is often called the running inventory because it tracks on paper rather than physically counting. And 2 people are recommended, one to count and call and one to record. So you want to have both inventories on hand to have checks and balances to make sure they're the same as you're going through. So basically, when you're establishing inventory controls, we're using the inventory sheet. And these should list ingredients by location rather than alphabetically. It makes it easier for those taking that physical inventory in the room to have all the ingredients and product listed on the shelves and on the sheets in the way they are. So it's shelf to shelf, left to right, top shelf to bottom shelf. You want to count all the products, and if you miss some items, it would go against your food cost because it would mean you used it up. So you don't want to miss anything. And then, of course, you have your inventory sheets, and these should be prepared with unit prices prior to the inventory being performed. While not required, this is strongly recommended for ease. Now here's an example of an inventory sheet. This is also found on figure 9.2 on page 130 in your book. That one has been extended out, and this one has not. You can see that the last column on this one is still blank here on the screen. The latest purchase price method is the management identifies the last price paid for each item in the inventory from the invoices and records. Once the inventory has been counted and recorded, the inventory is extended by multiplying the quantity by the unit price. Each individual sheet is then totaled. The totals of each inventory sheet are combined to give a total inventory for the date it was taken. So let's go back to the example. The price would be the latest one that was on your most recent invoice. That is what you will be selling it on based on the last invoice price, because that's what it would be worth if you were to close down. So you have to use the last price. Now, the physical inventory becomes either the opening inventory or the closing inventory in the cost of sales formula. For example, inventory dated October 1st, 2016 is used as the closing inventory value for September and the opening inventory value for October. Now let's look at the cost of sales. Cost of sales is the cost of goods sold. COGS is the business name for it, and it's the total dollar amount a business spends to purchase the food and beverage it sells. So we have the cost of food sales equals food cost. It's the total dollar amount spent to purchase food and beverage items needed to prepare food sales. And then we have the cost of beverage sales, and this equals our beverage cost. It is the total dollar amount spent to purchase food and beverages items needed to produce beverage sales. So, how are these cost of sales calculated? So basically we use the COGS, the cost of sales formula, or the cost of goods sold formula. This is general formula, can be found on page 130. We do it for all food and beverage, but they both use the same formula. What we have up here is the food one. So we take the opening inventory amount, and then we add any purchases, any dollar amounts in the purchases. This comes from using invoices or receiving forms. And this gives us our total available for sale. Then you'll take the total food available for sale, and you'll minus the closing inventory, which you will add up in the next month from your physical inventory at the end of the month. And that will give you the cost of food sales. And that's how we figure out our food costs. Now remember, the cost of food sales and the cost of beverage sales are calculated individually using their specific inventories. So let's look at a beverage inventory. You can see it's the exact same. The COGS formula for the cost of beverage sales is opening beverage inventory. This is the beverage inventory at the beginning of the month. We add any beverage purchases. This is the total beverage invoices plus any receiving forms. And this equals our total beverages available for sale. From this total beverages, we deduct or minus out any closing beverage inventory. This is the inventory at the end of the month. And this will give us the cost of beverage sales. And it's the actual cost of beverage. Now let's take a look on page 131 of your textbook, Perpetual Inventory. A bookkeeping inventory that keeps a daily running balance of quantity and cost of products on hand. Okay, so we bought 10 steaks today. We add that to the inventory of 20 we already had. Now requisitions come into the storeroom and they send out 10 steaks to the fine dining restaurant. And now they look at their form and notice they should have this many left. So it's kind of just like a running total of your inventory. It's an effective tool to control your beverage inventory. They call this tool a bin card. It's a tool often used to track beverage perpetual inventory. They use it in correlation with a break sheet, which we'll talk about later. One thing to note is that the perpetual inventory should always be equal to the physical inventory on hand. So as you can see here, let's take a look at this bin card for perpetual inventory. Now this can be a physical card as well as the one shown on page 132, figure 9.5. Lately, bin cards are set up as a computerized inventory system. And as I'm noted on page 131, when beverage products are delivered and put into storage, the inventory on a bin card is increased. And when the beverages are requisitioned out, the physical inventory is reduced. So you can see we're kind of getting this perpetual inventory, also known as the running inventory total of this bin card. These are mainly for items that can be easily stolen and your highest priced items. It's basically an inventory optimization, ABC analysis, and it's an inventory categorization method in which consists of dividing items into 3 different categories, A, B, and C. A being the most valuable items, C being the least valuable ones. When doing this method, the A inventory applies to the Pareto principle. This is also referred to as the 80-20 rule, where 80% of output is determined by 20% of the input. They comprise a relatively small number of items that have a relatively high consumption value. So it's logical that analysis and control of this class is relatively very intense, since there is the greatest potential to reduce costs or any theft or losses. At any given time, a manager can go into the inventory and should be able to count the exact same as the bin card. If they're not, this is where theft happened or unreported breakage. So as you can see here, there should be 16 cases on this date of April 30th of Mountain Sparkling Spring Water. Okay, so let's switch gears now and talk about the inventory turnover rate on page 131. This is the number of times an inventory replaces itself on an annual basis. This is usually taken every month and added up all to get an average over the 12 months. So the basic formula is the total cost of your annual inventory divided by your average monthly inventory, and this gives you your inventory turnover rate. This is calculated individually for both food and beverage rates. And the food inventory turnover rates may average approximately 30 times per year, almost 2 to 3 times per month. It's the same with the beverage inventory turnover rate. The beverage inventory turnover rates are a little bit lower. You don't have spoilage and they're not used up as much, so the rates may average approximately 10 times per year, just less than once per month. So what can the food and beverage turnover rate tell you? Well, if it's higher than the normal, it might mean that the purchaser is spending too much time purchasing and receiving goods. They don't need to do it so often. If it's lower than the normal, this might indicate maybe you're storing too much product and tying up all your money in inventory that can be used much better elsewhere. So you don't want to have a lot on hand because it opens you up to pilferage and theft or spoilage. But not enough on hand and your receivers come in and constantly unloading trucks and tying up their time. Like instead of ordering a case of soda a day, you would order 10 cases and store it for the week. Now, the flow of goods and costs continues on page 132. Now, the movement of the inventory must be tracked from inventory all the way into production. So, when goods are received, they're identified as direct purchases or as storeroom purchases. Direct purchases come in and are directly put into production. When they're stored, they go into the inventory and a requisition is made to take out of the storage facility. A requisition lists food and beverage items and their costs being removed from the storeroom and sent to production areas. We do this so we can track the food during the process with the forms that we use, like recs, transfer memos, and so forth. The whole objective is to limit access to storage area. The storeroom cannot be free for all for anybody coming in and going and getting stuff, whatever they want. This opens you up to theft and a lot of missing product. When we talk about beverage controls on page 132 to 133, we want to help control the in-process inventories. So empty bottles are not disposed of immediately. They're stored and tallied at the end of the evening and documented on a break sheet. This break sheet lists the types and quantity of beverages consumed and emptied. This is used with the beverage par stock system at beverage service locations to prepare a beverage requisition, which lists beverage items to be sent to the bar location. Okay, this is an example of a requisition found on page 82. When removing items from the storage areas, they go directly into food costs. So, how do we transfer these products? Well, we use a tool called the Food and Beverage Transfer Memo, and this transfers your products from one production area to another's production area's food costs. So the Food and Beverage Transfer Memo allows for an internal business form that the departments use to transfer product from one production area to another production area. So it goes off one department's food cost and gets transferred to another that the products were transferred to. So this might mean the bar needs lemons and limes, and they transfer a case or two from the kitchen. So now the bar will eat that food cost and not the kitchen. This also works vice versa. So it just basically allows costs to be assigned to the appropriate cost area. The bar requests a gallon of milk from the kitchen. It's another example. So here's a picture of the Food and Beverage Transfer Memo, page 134, figure 9.7. Now sometimes these memos are not used in small to medium operations. They're used in the barter method, since the bar uses most of the limes and the kitchen uses most of the lemons. There's not a huge discrepancy in the cost, and one whole case of lemons would be attached to the kitchen food cost, and the limes would be attached to the beverage cost. So in smaller operations, they kind of use the barter system. So what form should you use? The larger the business, the more forms are used. The smaller the business, it's basically what's more cost effective for them. So thanks for watching this video presentation. I look forward to seeing you all in class.